Okay, let's dive right into this explainer and tackle two of the absolute biggest headaches in Forex trading. I'm talking about extreme market volatility and that slow, agonizing bleed of overnight fees. If you're out there actively participating in global markets, you know exactly what I mean, right? Well, today we are unpacking a financial instrument that helps you completely neutralize those threats. Because think about it. If you've ever watched your hard-earned profits just vanish due to a sudden, unpredictable price shift, or you've sat there watching daily holding costs slowly eat away at your margins, you've probably asked yourself, how do the pros actually beat volatility and overnight fees? Like, how do they protect their capital and hold positions for weeks without getting totally drained by hidden costs? So, here is exactly how we're going to break this down today. 1. The currency risk problem. 2. What is a swap? 3. How Forex swaps work. 4. Strategies and key benefits. 5. Top broker platforms. And finally, 6. The takeaway. Section 1. The currency risk problem, volatility, and costs. Let's start by talking about the dreaded Forex rollover. Simply put, this is the process of extending a currency position overnight. And yes, it typically involves a fee. Every single time you hold a trade overnight, bam, you get hit with this rollover charge. And over time, these costs act like a slow leak in a tire. Seriously, they will steadily deplete your trading capital if you aren't paying close attention. It's an expense you absolutely have to control if you want to maintain long-term profitability. Section 2. What is a swap? Meet the solution. Okay, so what actually is a foreign exchange swap? Well, it's a simultaneous agreement to buy one currency and sell another at a specific rate today, while reversing the transaction at a future date. So you're essentially doing two things at once here. You're buying one currency and selling another right now, but with a formal, locked-in contract to reverse that exact same transaction down the line. The real beauty of this? There's no physical delivery of cash required. Instead, it lets you lock in future rates for your transactions, completely bypassing whatever crazy volatile market conditions pop up in the meantime. And this right here illustrates the absolute core of currency hedging, which is a technique used to reduce the impact of adverse currency movements. By locking in those future rates we just talked about, swaps act as a literal shield for your portfolio. You don't have to sit there sweating over every tiny market fluctuation anymore. You've actively reduced your exposure to risk, meaning you can actually focus on the bigger picture of your trading strategy. Section 3. How Forex swaps work, step by step. To really visualize how this plays out, imagine a US trader who wants to eliminate the risk of the dollar fluctuating against the euro over a fixed period. They'd execute 3 simple steps. First step, the initial currency exchange. That means converting their US dollars to euros today. Second, the agreement for reversal, the contract to trade those currencies back at a specific future date and rate. And finally, step 3, calculating the interest rate differential. Depending on the rates of the currencies involved, you either gain an additional profit or incur a calculated cost based on that rate gap. Now, I really want to emphasize that third step because it is absolutely the secret sauce here. The difference in interest rates between the two currencies is the key mechanism. It's literally the engine that can generate additional profit for you. Think about it. If you hold the currency with the higher interest rate, that gap works entirely in your favor. You are making the underlying mechanics of the global economy work directly for your portfolio. It's brilliant. Section 4. Strategies and key benefits, maximizing returns. So how do we actually use this? Well, you have options based on your specific goals. You could use a standard currency swap purely for risk reduction, basically just exchanging currencies to mitigate the risk of wild price fluctuations while keeping your flexibility in international trades. Or you can use an interest rate swap. This is where you're actively benefiting from those rate differences to optimize your financing costs and boost your returns. So it really comes down to risk defense versus proactive financial optimization. The benefits here make swaps an absolute must-have tool for the pros. Why do they use them? Well, by eliminating those daily rollover fees, your overall costs drop. And because your costs are lower, you can safely increase your leverage and hold larger positions with way less capital. Plus, they open up fantastic hedging opportunities. And honestly, perhaps most importantly, you get predictable long-term stability. You get solid returns without having to stay up all night monitoring the charts. Ultimately, the goal is beautifully simple. Lock in your rates today, secure your stability, and sleep soundly tonight. By fixing your rates ahead of time, you maintain absolute stability in your long-term positions. It gives you a level of certainty for your financial planning that naked trading simply doesn't offer. Section 5. Top broker platforms, where it happens. Let's look at the current market landscape because there are some truly phenomenal options out there for executing these trades. For instance, AvaTrade. They have a 4.7 out of 5 rating and offer fantastic stability with fixed spreads. They're definitely best for beginners and long-term investors looking to hold these swap positions. Then you have IC Markets, also rocking a 4.7. They provide ultra-low spreads starting right from zero point 0.0 pips, which is exactly the kind of liquidity and speed best for high-frequency traders and scalpers. And finally, XNES with a 4.6 rating. Their key feature is having no minimal deposit, making them incredibly flexible and perfect for traders of all skill levels who are just bridging into these advanced strategies.
Section 6, the takeaway, mastering market risk.
I think this quote from foreignexchange.live perfectly summarizes our explainer today. They note, foreign exchange swaps are a powerful tool for managing risk and optimizing trade strategies. And it's so true. These aren't just dry financial jargon to memorize and forget. They are essential, everyday tools for enhancing your profitability. Whether your goal is hedging against market volatility or capitalizing on global interest rate differentials, mastering the swap is a huge defining step in a trader's journey.
So, now that you understand the mechanics operating behind the curtain, how will you manage your market risk? What step are you going to take next to protect your own trades from the crazy volatility of the forex market? Are you going to keep letting those unpredictable overnight fees slowly bleed your capital dry? Or will you take control, lock in your rates, and leverage the incredible power of the forex swap? The choice is entirely yours.